At a minimum, you should always be trying to go for a profit that is at least twice your risk. If you buy on a stop above this bar and you put your stop just below it, this is 2 times your risk. So your risk is from your entry price to your stop, and that's twice that distance. Therefore, your reward is twice your risk. If you do that, you have structured a good trade. And if you do that consistently, you have a very good chance of being a consistently profitable trader. When I talk about structuring a trade, I'm talking about thinking about your position size. Where's your profit target? How much risk? How likely it is that you're going to make your profit? I add the lines and the entry boxes, sometimes the exit boxes, and I add text with the reason for my behavior. I create charts every day. You'll see them on my blog. I call them my daily setups. In my blog, it's free. Anybody can look at them. When I'm marking up any chart, I'm always beginning with lines. And then I look for channels, wedges. A wedge is a channel, and it has 3 or more points. I could draw a channel up like this. It has point 1, point 2, and point 3. Sometimes wedges are contracting, sometimes they're not. This one's fairly parallel, maybe a little bit contracting, the way I have it drawn. When a wedge is rising, I'm looking for a reversal down. So I'm really only interested in the top line. Most patterns are not perfect, and therefore I would not expect the 3 points to be exactly at the line. One of the 2 points here or here is going to be above the line. The more perfect a pattern is, the more computers will find it, the more computers will trade it, and the more reliable the pattern will be. The higher the probability it will unfold the way you want it to unfold. I always start with point 1, and then I could draw a line using point 2, and the line would be there. Or I could use point 3 to draw the line, point 1 and point 3. So there are 2 ways to draw the line. All lines start with point 1, and I could either create a line using point 2 or point 3. It's rare to have a perfect wedge where the 3 points are on the line. Almost all wedges have either one of the 2 points above the line or one of the 2 points below the line. For the blue line, point 3 is below. For the pink line, point 2 is above the pink line. Point 2 overshot the pink line. Point 3 undershot the blue line. My routine is to always choose the line where there's an overshoot. I like overshoots. Since the blue line has an undershoot, I'm not going to use the blue line. The pink line here, point 2 is an overshoot, and I want an overshoot either at point 2 or point 3. So I'm going to use the pink line and get rid of the blue line. I'm looking to sell a reversal down from the top of a channel. If we start to reverse somewhere around a possible line using 1 or 2, I'm going to look to sell a reversal down, especially below a bear bar closing on its low, expecting lower prices. After I draw the first line, I then look for other channels, other wedges. And there are many varieties. I have an encyclopedia of chart patterns that talks about all the different ways that patterns can unfold and appear. And there are many other wedges on this chart as well, and I just keep adding lines for every conceivable wedge. There are 3 pushes down here, 1, 2, 3. I have a little pink line there, it's hard to see. And here there are 3 points down, 1, 2, and 3. When the pattern is small, it's a micro wedge. And then here, I could also use 1, 2, 3, or 4. Remember, a wedge is at least 3 lines, so we have a channel with at least 3 points in it. So that blue line is another way to draw a wedge. And I'm looking for a reversal. We got a reversal. I want to buy above a bull bar that closes near its high, hoping that we get a trend up. Sometimes patterns fail. We got a push up here, big bar, and then a small bar, and then a big bar, a second push up, and then a bear bar, and then a third push up. So we have a wedge and a very tight channel. I would call that a parabolic wedge, but we did not get a reversal down below the bear bar. Instead, we get an upside breakout. So I would look to buy above the high of this bar, betting that the wedge top has failed. Next, I'm going to look for double tops and double bottoms. Double tops and double bottoms are rarely perfect. If you look for a perfect pattern, you're not going to find many setups and you're not going to trade very much. So it's better to be flexible. Here we're rallying. We broke above this high, but I always look to the left to see the context. If there's a possible double top, we might get a reversal down. Here, we rallied and it looks like we're turning down. I'd be inclined to sell below this bar, depending on reasons. I'll look to the left to see if there's a double top. This high might simply be a test of these highs, so it might be a double top with these highs. Remember, I also had a wedge here, 1, 2, 3, so it's a wedge and possibly a double top with that high, maybe a lower high, double top with that high. So a wedge and a double top is an added reason to look for a reversal down, selling below a bear bar closing near its low. And there's also a micro double top here. This bar went up and down, and this bar went up, and here we're going down. So we have a micro double top, a double top, and a wedge. So there are several things going on here that would make me more inclined to take that short. Here's another double top. The market tried to reverse up, but it failed in the neighborhood of that high. So it's a double top bear flag. I also want to look for double bottoms. The second low of a double bottom can be below the low of the first low. Here we tried to get a double bottom, did not go very far. And here we have a higher low double bottom. Here's a lower low double bottom. This low is below that low. And here this low is above that low. So it's a higher low double bottom. And again, a micro double bottom. We went down here, we went up, we went down, and now we're trying to go up again. You could buy above this bar or above a bar buying on its high. Here we have a very big double bottom, and it's a higher low above the bottom of the bear trend. So it's a double bottom, higher low. And that has the possibility of being a major trend reversal into a bull trend. There are often triangles on charts. And again, they're rarely perfect. We have rising lows here, and we're basically sideways here. We tried to break to the upside, and that reversed down. So that's a contracting triangle. And sometimes triangles are expanding. Here we have this high above that high, and this high is above that high. So we're going up, and then here we're going down. So an expanding triangle, 5 points, 1, 2, 3, 4, 5. And we keep getting false breakouts. A new low, new high, new low, new high. Again, a reversal pattern. I'll sell below that bar. I also look for special bars, big bars or small bars, inside bars or outside bars. Here we have 3 consecutive bull bars, not much overlap, and this bar is closing on its high, this bar is closing on its high. So this is sustained, strong buying. And the context is good. Remember, it's possibly a double bottom with this low, and the double bottom is above that low, so it's possibly a double bottom, higher low, major trend reversal. It's a surprisingly strong rally. It's a bull surprise rally, and bull surprises tend to have higher prices. And what took place here? This bar, its high is at the high of that bar, its low is below. So that's a variation of an outside bar. And look at the bar before it, this bar. Its high is above that bar, its low is below that bar, and therefore it's an outside bar. And this is a bigger outside bar. So outside, outside, consecutive outside bars. It's a breakout mode pattern. Traders will buy if the market goes above, and they'll sell if it goes below. So I'm looking for an OO, and I would sell below the low of that bar and below that bar. A bear bar closing near its low, I'd sell below that bar as well. The special box is drawn in. Next, I'm looking for entries. If I'm looking to buy, I want to buy above a bull bar, preferably one that is closing near its high. If I'm looking to sell, I want to sell below a bear bar, preferably one that's closing near its low. Theoretically, if we have consecutive bull bars here, it's reasonable to take that buy. However, it turned out to be a failure, and I would get out either below this outside bar or certainly below that, because at this point, there's a sell. Sometimes I'll put an outline around a green box or a red box. And when I do that, I'm trying to highlight setups that are particularly good. They're ones that a person starting out should try to take. After I draw in the buy entries, I then draw in the red boxes for sell setups. So this bar, reasonable to sell below. And here we have an OO pattern below the moving average. It's an especially good sell, so I would sell below that or I'd sell the first pullback. And then here we have a whole bunch of things. We have an expanding triangle, a micro double top, possibly a double top here, and we have a wedge rally to a double top. and it's nested. We have a smaller wedge here and a bigger wedge here. So this is a very good sell. We have a second consecutive bear bar closing on its low. That's also a high probability sell. So I put a blue outline around the red box. And then I add text boxes so people can understand some of the rationale for why I'm taking the trades. And this is something you should consider doing every day at the end of the day, marking up your charts. You don't have to write the text boxes in, but I would certainly draw lines and highlight special bars. If you do this for several months, you'll begin to recognize patterns unfold during the day, and that will allow you to anticipate trades. And then when the trade triggers, you'll be able to take it and you'll be able to manage it well. And that is what I mean by practicing trading. Again, it's important as a trader to do the same thing every day, have routines. One routine is to mark up a chart at the end of every day to practice so that you'll develop a lot of experience in your ability to recognize patterns. Second, use the same approach for every market and every time frame. When I'm marking up a chart, I begin with lines. I usually begin looking for channels, wedges, and then double tops, double bottoms, and triangles. After that, I'm looking for unusual bars. For example, big bars or a series of big bars, surprise bars. I also look for small patterns like consecutive inside bars or consecutive outside bars, or an outside bar followed by an inside bar. That is an IOI pattern.